They said the corporate world would never go hunting for digital tokens as if they were this century's precious gold. Yet here we are, witnessing some of the biggest names in industry pouring millions upon millions of dollars into an asset that not so long ago was perceived as a fringe experiment. Has the corporate gold rush truly arrived in the form of Bitcoin? And more importantly, what does this corporate frenzy mean for everyone else who watches the crypto markets with wide eyes and a pounding heart? Today, we are going to dissect one of the most electrifying trends in modern finance: companies stockpiling digital coins, and whether that is a triumph for Bitcoin's future or an ominous sign of growing centralization. Make no mistake, we are not talking about a few small players flirting with the possibilities of decentralized currency. We are describing actual giants stepping in with major positions, from Tesla's headline-making foray into Bitcoin to the eye-catching moves by Square and MicroStrategy. These treasuries are beginning to glow gold-like on corporate balance sheets. But what does it all mean for the underlying ethos of decentralization? In this saga, we will pull back the curtain on the hidden motivations behind these corporate strategies, the escalations that push the industry to new highs, and whether this spells a new era for digital finance or a looming threat to the entire ecosystem. In this episode, we are going to rigorously explore the main questions fueling this debate. 1. Is the institutional presence in Bitcoin truly the validation it has always yearned for, or is it a Trojan horse undermining its grassroots vision? 2. Does the accumulation of large Bitcoin holdings by publicly traded companies set the stage for lower selling pressure, or is it just going to shake the volatility even more violently? 3. Will these corporate moves accelerate bridges to the world of traditional finance, or will such expansions compromise the decentralized essence? We will examine how network effects drive the value of Bitcoin, why some corporate treasurers remain cautious of potential instability, and what happens if an entity that holds a mountain of these tokens suddenly decides to sell. Stay with us as we follow the labyrinth of impetus and consequences that could change your perspective on corporate involvement in digital money forever. They call Bitcoin digital gold for a reason. It is a currency with a famously limited supply at around 21 million tokens, which can make it feel like searching for the last veins of hidden treasure in a vast and trackless wilderness. Corporations, especially those in the United States, are hunting for these tokens in earnest this year, spurred on, in part, by the desire to shore up reserves and capture gains. The push began quietly, but soon announced itself with the force of a thunderclap. Large-scale purchases triggered seismic waves in cryptocurrency markets, adding new layers of stability to Bitcoin's market price. Or so the story goes. Speculation and hype have only ramped up as each new corporate entity reveals its intention to load up, generating both applause in some corners and deep anxiety in others. So let us begin with the bright side, the notion that these institutional moves confer a seal of approval on Bitcoin. For years, some critics doubted that digital currencies would ever be taken seriously by big business. Bitcoin was ridiculed as intangible, ephemeral, not to mention overly volatile. However, when corporations that are widely followed by investors take an active role, announcing major Bitcoin holdings on corporate calls, something fundamental shifts in the public consciousness. Now, for more traditional investors who once felt uneasy about dipping a toe into digital assets, the presence of these more established corporations can serve as a comforting signal that the party is real, that the technology is here to stay, and that we are finally crossing a threshold into mainstream acceptance. When Tesla, Square, and MicroStrategy confidently declare that Bitcoin is a better store of value than many alternative assets, it resonates in a way that a purely anonymous online forum discussion might not. Of course, institutional validation does not merely soothe the nerves of the uncertain. It also spares entire categories of potential investors from wondering whether Bitcoin is, in fact, some kind of ephemeral dream that will vanish once the fad passes. By placing Bitcoin on their balance sheets, these corporate behemoths reassure people that it is something tangible enough to be considered an asset worth cherishing for the long haul. That does not mean everyone is convinced. There are still notable naysayers, from traditional economists to gold bugs who see no real point in intangible bearers. Nonetheless, for a growing number of aspiring adopters, it is one more reason to believe that digital currencies have crossed into the realm of legitimate investments. And while we are on the bright side, let us look at what happens to selling pressure when some of the most deep-pocketed participants are willing to buy big and hold for the foreseeable future. Corporations, after all, do not usually day trade. If they have joined the race to accumulate Bitcoin, their approach is akin to locking up supply. Bitcoin is notoriously deflationary by design, and the fewer tokens that are readily available on exchanges, the more likely it is that prices will have a solid floor. When large players consistently buy and stash away their holdings in cold storage, the quantity of tokens whipsawing around on trading platforms decreases. For some advocates, that is a strong reason to believe that the days of drastically crashing prices could diminish. And let us be honest, removing tokens from the open market is often a recipe for bullish surges, as new buyers scramble to get what is left. If you are finding this discussion fascinating and appreciate deep dives into the controversies shaping cryptocurrencies, feel free to gently tap that like button to show your support. It helps more enthusiasts discover these insights. Let us forge onward. For many watchers of this phenomenon, a highlight is how corporate participation is paving the way to merge Bitcoin's new technologies with centuries of financial tradition. Software developers, always on the lookout for the next big frontier, see an enormous opportunity. If companies and financial institutions are focusing on Bitcoin, it is in developers' interest to make the on-ramps, the tools, and the custody solutions as seamless as possible for an influx of fresh capital. Indeed, the entire concept of bridging Bitcoin to what we often call traditional finance stands to accelerate as soon as corporate players demand top-tier security, regulated custodians, and products such as exchange-traded funds or derivatives that revolve around Bitcoin. If these financial on-ramps expand, the number of participants who find it practical to purchase or store Bitcoin will multiply. Thus, ironically, what started as a shady corner of the internet is now on the cusp of influencing bankers in three-piece suits on Wall Street who do not want to be left behind. Add to that the unstoppable power of the network effect. For a currency, a social media platform, or any system organized around user adoption, the more participants, the more valuable it becomes. It is akin to a party. One cannot have much fun if only 2 people show up. But if hundreds arrive, each new guest has even more people to interact with. Bitcoin, at its core, is an intricate tapestry of hashed blocks protected by distributed miners around the globe. But in real economic terms, it is also a social phenomenon. The presence of large, publicly traded corporations amplifies the conversation. People may see major companies staking a claim in Bitcoin and think, if they are doing it, it might be time to pay attention. This effect can escalate quickly, shifting from a trickle to a flood of new interest, and each subsequent wave is bigger than the last. Lynn Alden, a well-respected investment strategist, has made the case that Bitcoin's network effect is not just hype or mania, but a robust driver of its long-term price growth, overshadowing the occasional short-term dips. For much of the corporate world, there is also a defensive hedge narrative. We are living in times of considerable economic uncertainty, replete with swirling headlines about inflation, macroeconomic volatility, and supply chain disruptions. Companies often hold some portion of their assets in cash or equivalents to weather storms, but that cash can suffer loss of purchasing power when central banks inject liquidity or print currency. By allocating a fraction of treasuries to Bitcoin, these companies are effectively stating, "We are aware of the inflationary risks, and we believe Bitcoin may hedge those risks." Yes, it is very possible that these are well-funded speculation strategies rather than purely prudent hedges, but companies can position them as a defense mechanism against an uncertain future. Some have gone so far as to claim that Bitcoin's scarcity may outperform gold in the long run, especially as more consumers turn to purely digital forms of exchange. And let us not forget the snowball effect. Here, the fear of missing out, commonly called FOMO, plays an essential role. Suppose a handful of notable corporations buy large sums of Bitcoin, watch the price climb, and then boast impressive returns in their quarterly calls. That scenario can light a spark within boardrooms across the globe. No executive wants to explain to shareholders why a competitor's treasury soared by a significant percentage while their own remained stagnant. Hence, more players might jump in, fueling an even bigger wave of excitement and reaping additional gains in the process, at least so the theory goes. But let us halt that positivity train for a moment, because it is not all roses and green candles. There exists a flip side to the corporate involvement that has many in the crypto community on edge: the risk of centralizing too much Bitcoin in fewer and fewer hands. The entire point of a decentralized digital currency is that no single entity or small group of entities can hold it hostage. If a clutch of major corporations end up controlling a substantial percentage of the total supply, it changes the dynamic. Though it does not compromise the underlying blockchain security, miners, nodes, and consensus mechanisms remain distributed, it can shift market power in ways that might cause friction down the line. Imagine one day that the top 5 corporate holders collectively have a huge chunk of the total long-term supply. Then, if one or more of them decide to sell off a significant portion, for reasons including liquidity crunches, public relations issues, or strategic realignments, it could send shockwaves through the market. While volatility is nothing new to crypto, sudden large-scale liquidations by corporate holders might amplify panic far beyond the usual cycles. This potential meltdown scenario is precisely how large concentrations of tokens in corporate treasuries might set the stage for bigger booms and busts than ever before. Another concern is that if some corporate players are not truly committed to Bitcoin's philosophy, they may treat it more like a fad or a speculative weapon to goose returns without believing in its underlying fundamentals. When that happens, corporate enthusiasm could ebb and flow with market trends, intensifying mania when prices rise, but provoking abrupt retreats that tear at the fabric of trust. Bubbles and busts can be devastating for the small retail investors often left clutching the remnants when the bubble pops. This is not just a hypothetical scenario either. In the crypto winter of 2022, we saw multiple high-profile institutions that held significant digital assets stumble and crash, tarnishing the image of crypto markets at large. Those who have been around Bitcoin for a decade or more argue that elongated hype cycles and the infiltration of corporate treasuries might overshadow the original dream, a peer-to-peer currency that works as everyday money, free from gatekeepers or big banks. The more that Bitcoin evolves into a trophy asset for large-scale speculators and treasury managers, the more we might lose sight of its potential as a daily transactional medium, a tool that wrestles payment freedom out of the hands of powerful intermediaries. There is a legitimate question as to whether Bitcoin becomes more akin to a corporate ledger entry in the name of hedge strategy or speculative treasury instead of an unstoppable instrument for permissionless exchange. This tension between the store of value crowd and the currency for daily use crowd has been sizzling behind the scenes in Bitcoin's community for years, and corporate involvement may tilt it heavily in favor of store of value usage. The threat of inflated volatility also looms large. Bitcoin, for all its potential, is known for taking investors on extreme roller coaster rides. With gigantic lumps of supply in the hands of huge corporate actors, one big decision from a board of directors might lead to a tidal wave of tokens hitting the market. Picture an economic crisis in which, for instance, a company deems it necessary to liquidate its large Bitcoin holdings to shore up its main business lines or pay debts in a pinch. The ramifications could become cataclysmic for those perched on the edge, expecting stable price movements. Then again, some might say that volatility is Bitcoin's middle name, and that the wild nature of crypto is simply the price you pay for being part of such a revolutionary technology. And we must not forget how corporate influence might bend the narrative. If everyday users see Bitcoin increasingly championed as a balance sheet solution for big business, then they may start to view it primarily as something that belongs to the privileged realm of suits and ties in large boardrooms. That could lead to disillusionment among the original supporters who cherished Bitcoin for its capacity to bypass the big players, leveling the playing field for individuals with mere smartphones and an internet connection. Over time, this shift in perception might undermine the sense of grassroots empowerment that originally drew many to decentralized currencies. The idea that Bitcoin could serve as a practical everyday payment method becomes overshadowed by the idea that it is essentially a new financial rung for those who already have plenty of resources. Which side of this debate is correct? Perhaps the reality is more nuanced than any single viewpoint allows. Bitcoin's unstoppable popularity might be a double-edged sword. The more it grows, the more it interacts with established power structures, which can simultaneously accelerate its adoption and transform its identity. Right now, we are at a fascinating threshold. As these events unfold, the question is whether the drive by corporations to hold Bitcoin in their vaults will ultimately boost the price floor, push for more integration with long-standing financial frameworks and spark a mass wave of popular acceptance, or whether it will gradually subvert the decentralized core Bitcoin was designed to uphold. After a flurry of corporate announcements earlier this year, it is apparent that digital money has captured the imagination of many executives. Boards of directors do not usually leap into new technologies without thorough deliberation. Indeed, these large purchases might indicate that a collective decision was made. Yes, global inflation is real, the technology is robust, and the time feels right to secure a quantity of Bitcoin for the future. Entering the fray so visibly, these corporations do more than just hold a currency. They become ambassadors for a phenomenon that was once relegated to passionate miners and crypto enthusiast forums. Meanwhile, the public sees headlines about companies netting robust gains thanks to price rallies and curiosity spikes. Articles and analyses go viral on social media. The cycle persists. Yet, a cycle can also break under pressure. The higher the price climbs, the more insatiable the thirst for quick profit. If that thirst proves to be short-lived hype, a day of reckoning may arrive when euphoria gives way to panic. Although it is possible that the presence of corporate balance sheets might help anchor the market, it is equally possible that those same corporate positions could withdraw en masse if conditions sour. And because some of these companies that bought Bitcoin have legions of watchers on social media, any signals of movement could start a hysterical chain reaction. In short, if markets sense that a major corporate player is losing interest or facing a liquidity crunch, widespread selling could trigger self-reinforcing fear. There are also puzzle pieces related to bridging Bitcoin and traditional finance. If the synergy is successful and corporations push for robust solutions, regulated exchange-traded funds, widely accepted derivatives, advanced custody mechanisms, among others, then stepping into the Bitcoin ecosystem might become as simple as sending an email. This could be a glorious development for those who have long argued that crypto is too difficult, too technical, or too risky for the average person. But it might also come at a cost. Increased oversight from regulators, potentially more stringent identity requirements, and a rising portion of tokens secured by large centralized financial institutions that might resemble banks under a different name. Some purists worry that this integration robs Bitcoin of its rebellious spark. For them, a heavily institutionalized Bitcoin might be safer for conventional investors, but it may no longer feel as free, subversive, or revolutionary. On the other hand, the presence of more traditional financial instruments usually confers greater legitimacy and acceptance, which in turn can elevate market confidence. The real question is how far the corporate suite is willing to push integration, and how flexible the open-source developer community and independent miners will be. Tensions about block size debates, layer 2 solutions, and the potential shaping of the code to accommodate large-scale business revolve constantly in community channels. These differences might remain manageable, or they could escalate into intense disagreements that threaten to split segments of the user base, reminiscent of previous Bitcoin forks. If you have been enjoying our deep dive into the corporate intrigue behind Bitcoin, this might be a perfect moment to subscribe. That way, you will never miss future explorations into the most riveting stories shaping digital finance. It is also interesting to consider the potential synergy with other blockchain networks. Ethereum, for instance, has gained traction for its smart contract capabilities, fueling an entire decentralized finance movement. As corporate players become more comfortable with one digital asset, there is a chance they might dip further into decentralized finance or experiment with bridging these systems. Some might imagine a tapestry of institutional-grade products that combine the best attributes of Bitcoin's store of value narrative with Ethereum's contract-based innovations, birthing an ecosystem where corporations can stake, lend, and borrow with minimal friction. But there remain plenty of regulatory and structural obstacles before we reach that level of interoperability. Above all, it is crucial never to lose sight of the fundamental essence. Bitcoin was conceived as a peer-to-peer form of electronic cash that bypasses intermediaries. Watching large companies take center stage in accumulation and adopting narrative transformations can provoke a swirl of contradictions. Are they championing Bitcoin, or are they co-opting it? Are they fueling its unstoppable march forward, or are they overshadowing the individual empowerment that originally distinguished Bitcoin from centuries of central banking paradigms? The truth may well be that Bitcoin thrives on dynamic tension. If it remains decentralized in its protocol design, it can continue to function no matter which corporations decide to buy or sell. Yet, psychologically among traders, seeing big holders shift momentum can spark new waves of speculation or fear. Stepping back, one might note that Bitcoin adoption probably comes in cycles, with each wave bigger than the last. Corporations represent but one piece of a vast puzzle, which also involves sovereign states, retail investors, technologists, and day-to-day users around the world. Whether corporate adoption ultimately becomes a net positive for Bitcoin could depend upon how responsibly these treasuries are managed, how well the community weaves in new layers of utility and governance, and how skillfully everyday users adapt the currency to their needs despite the presence of towering whales in the ecosystem. Corporate mania might well drive the price to new heights, or it might sow the seeds of fresh controversies and confrontations about the soul of Bitcoin. We find ourselves at a once-in-a-lifetime juncture, enthusiastically leaning forward to see what tomorrow holds. The narrative that so many dismissed as a niche hobby for cryptographers and ideologues only a handful of years ago has solidified into one of the most compelling dramas in global finance. Each day, new participants gather around the digital campfire to share stories of valuations rising, controversies igniting, solutions proposed, and visions of a future where money and information flow together across the planet. Whether you lean toward the belief that corporate involvement is the rising tide lifting all boats, or suspect it is a wave that threatens to sweep away the original intention and decentralizing power of Bitcoin, one thing remains certain. We are living in the midst of a transformative phenomenon. Organizations that manage employees and operate massive supply chains on every continent are stacking Bitcoin in their safes, effectively endorsing a technology that was nurtured by a handful of believers in a cryptography mailing list not that long ago. That is remarkable in its own right. No matter how the story ultimately plays out, these are the early chapters of a new era in money. From the vantage point of those who wish to see Bitcoin remain an open, borderless, and user-focused network, the hope is that broad corporate involvement will not overshadow the millions of everyday participants forging peer-to-peer connections and using Bitcoin as a personal store of value and potentially even as daily spending. The technology continues to evolve, from the earlier days of large proof-of-work operations to side chains and lightning solutions that expedite transactions at lower costs. Meanwhile, companies inch into the space, sometimes with bombastic announcements, sometimes quietly. This is only the beginning of a story that is poised to run for years, if not decades, shaping how we transact, how we invest, and how we perceive money itself. As for whether corporate Bitcoin piles are truly good or bad for the currency, the honest answer is that it is complicated. We should celebrate rising acceptance and also remain vigilant about the ways in which consolidation of wealth in a few powerful hands might skew or destabilize the system. The moral may be that Bitcoin acts like a mirror, reflecting many aspects of human nature back at us. It compels us to ask how power, trust, speculation, and self-interest interplay whenever new technology emerges. In the end, the corporate rush to stash Bitcoin is not just a financial tale. It is a mirror upon which society casts its fears and aspirations for what money can be in the coming decades. The final chapters in this story are yet unwritten, and each of us has a role, big or small, in determining the direction it takes. Whether you are a seasoned investor, a curious newcomer, or a corporate decision-maker mulling over a splashy digital purchase, the consequences of these decisions ripple far beyond the boundaries of any single boardroom. As you stand on the precipice of a rapidly changing monetary and technological world, remember that behind each rocket-like ascent and dramatic dip lay the passions, anxieties, hopes, and ambitions of countless participants who believe or disbelieve in the vision of a decentralized future. The question is, how will you navigate it all, and how will history record the dawn of corporate Bitcoin?